Okay, well, welcome everyone to the presentation on pass-through entity tax and election. My name is Neil Patel, Senior Associate here, and I'm joined with Ellen Minnig, who's our State and Local Tax Director, and Chris Benson, who's our State and Local Tax Manager here at PKF. There's a lot of things to cover on this new topic of pass-through entity taxes, as well as many nuances that's kind of created a sort of gray area on whether or not we need to advise our clients on making the election or not. And so let's get started. On our agenda, we'll go over the overview of the origins of the pass-through entity tax regimes and state enactments, how the entity level tax really works and who can make the election, considerations on whether or not to elect into PTET regimes, and then we'll go into some benefits and detriments, and then there's some models we have for you guys to kind of look at. So just going on to an overview perspective, pass-through entities that don't make the election and that haven't before are typically not subject to tax for federal and state purposes. I know that doesn't specifically apply to certain things such as minimum franchise taxes that certain states have, like Texas, Tennessee, and New York, but just from a general perspective, this is an entity level tax, and owners are taxed on their share of the PT's income at the individual level normally. So how did we get into this new PTE tax? It kind of started off in 2017 with the Tax Cuts and Jobs Act, which placed a $10,000 cap on state and local tax deduction on individuals. So this impacted many taxpayers that itemized deductions and were not allowed to take the deductions for taxes paid at the state and local level over $10,000. So that kind of spurred states to come up with their own proposals. And these were the first 7 states. I'll mention that Connecticut was actually the first state to enact a PTE tax, and then these other states kind of followed in their steps. And as those states were really going into their proposals and their bills being passed into legislation, the IRS notice 2020-75 kind of came in late 2020. The notice provided some guidance and essentially acknowledged that a pass-through entity tax exists, and they acknowledged that there was an intent that states were going to be able to work around this $10,000 cap. Again, Connecticut was the first and only state to really make it a mandatory election. That happened in May of 2018. And I know there is a way for you to specifically opt out of Connecticut's mandatory tax, but I actually went through the Department of Revenue website and dug through it a little bit and wasn't really able to find a way to opt out. So I would definitely do your due diligence if you are filing in Connecticut.
There is an opt-out election in the software, and I don't know if they've revised the form, but at least as of 21, there was an opt-out election. So we'll see if anything's different. But for 21, there should be an opt-out.
Okay, well, that's good to see, in our software at least has it, right? So after that, much of the floodgates opened for the state tax workaround, and now we have 22 states that actually issued pass-through entity tax enactments into legislations and to really help those taxpayers out in getting their full deductions for their state taxes paid. Here we'll see a map. So as you see, a lot of these blue states have really passed a PTE tax. Currently, Ohio and Pennsylvania, they're still in progress in getting those passed. I'm not exactly sure how far they are. They've been sitting on various desks in legislation.
Yeah, so to supplement that, the bill introducing the tax for Ohio was introduced in October. They're already moving into their 22 sessions, so pretty sure that one's dead, but I can't say for certain without going and checking right now. Pennsylvania was introduced in early spring 21 and kind of died on the table there. So they may reintroduce something in 22, but the proposed bill there is essentially dead.
Got it. Thanks, Chris. So we'll go into the effective dates. As you can see, Connecticut's still early leader for tax year starting 1/1/18. That's when it all kind of began. I will note that this is accurate in terms of when the tax year starts, and for Illinois purposes, the pass-through entity election is actually ineffective for tax years ending on or after December 31st, 2021. And a lot of these states kind of expire in 2026, from my understanding.
Neil, for Illinois, taxpayers can make the election for 21.
Correct.
Right. Okay. I thought there was a little confusion in something you said, so I just want to make sure that was said. Thank you.
Yep, and Illinois actually has said they're going to be waiving penalties and interest for any kind of late payers, I remember, up until the due date of the return. Just to keep that in mind for anything you prepare this year, right? So we'll kind of go into how the tax works. Here we have Billy Joel LLC. Joel's kind of an Illinois resident and Billy's an Indiana resident, both 50% owners. This is just kind of a high level example to kind of demonstrate how the tax is going to be directly affected. So if we have these are all facts on this page. So the federal taxable income will be $2,000. 75% of the activities in Illinois, 25 is in various other states. And then the LLC will make the Illinois pass-through entity election, and we'll kind of show the calculation here. On the state side, Joel will receive $1,000 in distributive share of income for Illinois purposes, and then Billy would have Illinois sourced income of $750. Going based off those calculations, they'll be paying $50 and $37 from the 4.95%. So if we see here, this kind of shows the difference between the K1 amounts as if they had not made the PT election and when they do actually make the PT election. And the big difference here, as you guys can definitely see, is that your federal income subject to tax decreases. Although these are kind of smaller numbers to work with, if you amplify this by make them $1 million, you definitely see the difference in what our clients or other client or taxpayers in general can make.
One of the key points Neil is making on this little visual graphic here is that making the election affects your federal taxable income, but has no effect on your Illinois taxable income.
And that's kind of how the states really want to work around the SALT cap, right? So we'll next go into some qualifications. It definitely varies state by state. And just to kind of brief you all on it, no two states are very much alike. There's different nuances and differences between each state and how they really treat the PTE tax. Generally, partnerships, S corps, and LLCs treated as partnerships or S corps are eligible to make the PT election. That's not going to include publicly traded companies or C corporations, since C corporations already pay tax at that level. And then I would just suggest that you go into the state guidances, and we actually have made a chart kind of to make it easier for us at PKF Mueller to decide whether or not we can even make this. And we'll kind of show, I think Ellen will show that at the end of the presentation, just so we all kind of have a resource that we can go off of. And I know the SALT team is going to be, the SALT team as well as myself is going to be working on that to keep it updated as more legislation is passed and we get kind of more guidance. The types of members that can make the election, resident and non-resident members, and then again, it's going to vary state by state that have differences in whether fiduciaries, estates, trusts, different partnerships are qualifying members. For example, in California, they exclude partnerships that contain non-individual owners from participating. So qualified taxpayers owners must be composed exclusively of individuals, fiduciaries, estates, or trusts. In addition, there's a kind of a unanimous consent of owners concept that's being into play, but not every state requires this to pay the PTE tax, right? So as an example, New Jersey requires all owners to agree to the election, but states like Alabama only require a vote or consent from certain individuals or owners to make the election. And that really also goes state by state. And I think our chart that we're creating or constantly updating is going to reflect that to make it easier for us to decide. So
Well,
there's
one thing to be careful with just on that last slide is, regardless of the state guidance on who can elect or how to achieve an election, we do also need to run that through our own internal filter with the operating agreement or corporate articles for the S corps, and determine if we have a structure in place that is capable of making an election that binds other partners.
Got it. Thanks, Chris. So there's a lot of considerations to take into account when we're deciding whether or not we're going to have a client make the PT election. As you see, there's so many questions that arise, and what do we really do in terms of it? Like, when does the election need to be made by? How's the election made? What are the different forms? Are estimates required? Due dates on those? And then there's different tax rates that apply, as well as the biggest thing kind of here is, will there be a credit? Is that refundable or non-refundable? Or is it an exclusion of income? So we'll jump on to when does the election need to be made by? On or before the 15th day of the third month is the general guideline for certain states. So I kind of put these two options as the two only options here, but there is kind of an other category, and I won't dive too into that. But the election, whether it's on the actual return itself or they have specific forms on those states, they're going to be one of these two due dates. But a thing to kind of keep note is that most states are requiring that the tax liability is going to need to be paid before the 15th day of the third month. That's kind of general, or that's kind of going along with how extension requests work, right? How are the elections made? Some states are using the PTET election as a mechanism to force business to file online. So for New York's sake, they're making all pass-through entities that are making the election file the election online and get into their online database. This seems to be the trend going forward, I believe, because they really want to streamline that process and get as many taxpayers online as they can. That's probably going to created administrative ease just from our perspective. And then the election can also be made on the return itself. Some states have a checkbox or a simple form, while others have forms that are almost 20 pages long that is just the pass-through entity tax election and tax kind of computation. Here's a list of forms that we have. As you see, like Colorado, Connecticut, and Illinois, the election is made on the actual return itself. Some of these other states have specific forms and form numbers already into legislature, and they're providing guidance on those forms. And then you'll see other states are still kind of behind and pending. A lot of those pending are due to their effective dates being in 2022, or they just simply have not put anything out there. Are estimates required and when are they due? So most states do have the requirements to make estimated payments. I'd say 90% of them are quarterly, if not more. So it's going to be your regular quarterly due dates. And then each state really differs tremendously in terms of their thresholds. Some are having taxable income thresholds, the tax liability is a certain number, and then percentage of prior year's elective tax. And then for Maryland's sake, their threshold is kind of on non-resident members tax.
I just wanted to mention on that one that for Illinois, there is a $500 taxable income requirement or tax due requirement. But they do have a different requirement for other estimated payments. So, and I've noticed that in several states that you do have to check specifically for the PTE required estimated payments. Their thresholds are a little different in some states than others.
Yeah, just based off what Ellen just said, partnerships and escorts making the election are not required to make quarterlies. For Illinois, it's going to include the pass-through entity tax and the replacement tax. If it's more than $500, they're going to require you to make quarterly payments. Like I said kind of earlier, the Department of Revenue in Illinois is waiving late estimated payments and penalties related to PTE tax for tax years ending in 22. So that also applies to 21 from what I understand off their website. They actually have a frequently asked question kind of guideline on the website. So I would definitely recommend checking it out if you are considering making the election.
Yeah, to quickly clarify there, it is a strict before, not on or before. So if you've got a fiscal year 22 return that ends before December 31st, you would have this estimate relief. But if it's a calendar year 22 return, you will have estimated payment requirements. And the other thing that's worth emphasizing here, it was stated and printed above, but we are not used to making estimated payments for replacement tax for pass-through entities. It's just not statutorily provided for. That wasn't changed in the bill that enacted the pass-through entity tax. They just pointed a reference to the existing estimated payment statutes. But the department is asserting this kind of combined requirement where you look at both taxes combined for the estimated payment requirement. So that is something to consider, that could increase your potential for underpayment liability if you're making this election and have substantial replacement tax.
And just to add quickly, the other thing there is that even though they're looking at both those taxes for whether the estimated are required, they're only looking at they're only looking at a PTE calculated net income for application of PTE tax.
So for California, this is the one that's kind of different. Their estimated payments are kind of split in two. The first one being to be made by June 15th, and then the next payment is going to be the remaining amount for estimate purposes. The first payment needs to be $1,000 or 50% of the elective tax paid in the prior year. So here we see kind of the the pass-through entity tax rates by each state. The glaring high ones are obviously California. Oregon is relatively high, I'd say. And then Minnesota and New York, which are simply high state taxes.
Just one more comment on that. Usually, not in every case, but usually the PTE tax rate is somewhat lower than the composite rate as addressed by most of these statutes.
Yeah, and some are also a progressive tax base based on the sum of each member's share attributable to the PT. I know that's the case for a state like New Jersey. So you really kind of got to go into the computation to see if it's going to be beneficial, right? So each state kind of treats the pass-through entity tax a little differently. As you can see, there's not really an obvious trend. If you want to say the northern states have refundable credits versus exclusion, you can, but there's no real trend here. But the fact that states differ in these qualities and that so these are kind of the ways that you're really working around the $10,000 SALT cap at the individual level. A non-refundable credit, such as California and Arizona, this is going to allow them to claim the credit of amount tax paid on the qualified taxpayer's share of income. And then for the non-refundable credit, they're going to be able to carry them forward for 5 tax years. And that kind of plays an effect when we go into the modeling, and you'll see that later. But the way it plays an effect is if you have large carryover amounts going forward, are you allowed to use them? And are you going to be expecting to have taxable income in the next year? Should you make the election? These are kind of questions you're going to have to raise to yourself and kind of going through our clients. Refundable credits, pretty similar, except you're able to get a refund, right? They'll be able to claim a refund on a refundable Illinois credit equal to the entity tax paid, and the excess is refunded. In terms of other states, so if we go back to the map, you'll see Oklahoma, Louisiana, Alabama, and those other states. These states are going to have an exclusion of income. So owners of the pass-through entity that has paid the tax, that paid the pass-through entity tax may deduct their distributive share of income from the AGI in that specific state to offset their state liability. And this is kind of where you really have to run through a sort of model for our clients to see if they will benefit directly from this and to whether see if they will have a credit or exclusion in general in these electing states. We'll next go into potential benefits and detriments. So benefits that we're kind of seeing after kind of doing our own research and going through each state and kind of digging into the legislation that really comes through is that general benefits are that they reduce federal taxes because you do get that deduction as you saw in our high level example. There's going to be an administrative ease and convenience for partners and shareholders if the entity is paid at the entity level. It just makes it easier for partners not to have to calculate their own distributive income and then make estimated payments on that. That can be done at the entity level. The liability for the tax transfers from the individuals to the entity to one degree or another, I will say, because they're still going to be receiving income and be liable for that tax. But as far as the entity goes, the entity will be liable for that tax. Pass-through entity tax rates are generally lower than composite rates. Ellen, do you want to touch upon that? Okay.
So that comment is mostly targeted to California and New York. The pass-through entity rates don't touch the highest marginal rates, so it could be savings over a composite return. But of course, you're then having to file an individual return the same as if you were just a typical flow-through entity, and in that case, you could have a result where the credit you receive is not sufficient to cover the tax they owe if they are in a higher marginal bracket.
That's the main thing. Those are the two bigger states. There are some differences in other states, and some of them they're exactly the same for PTE and composite, but generally there's some sort of at least a small difference. But California and New York will be the big ones to look at, whether they can benefit or whether that's a further issue to look at.
Chris, do you kind of want to explain the reducing of self-employed income?
Sure, yeah, that one kind of connects to the first point. Really from a straightforward nature there. If you are an active trader business generating self-employment income by reducing your box 1 or box 2 K1 income, you have effectively reduced your self-employment income. Obviously, if you are a rental activity, you're not necessarily going to see that, but for our operating partnerships, there's potentially another slice on top of that pass-through entity tax deduction.
Thanks, Chris. Another potential benefit that we see are the states that have refundable credits. That's definitely going to become a benefit if you want to make sure you're covering all your tax liability in those electing states. And then that it removes non-resident withholding and composite payment requirements. This we're seeing across a couple states. And that's generally going to gear towards entities that have been making withholding and composite payments in prior years. Ellen, do you have anything more on that?
On that point too, so I mean, generally that makes sense. That's the logical result is if you're paying at the entity level, you no longer are required to do withholding or make composite payments for your non-residents. So that should really be applied across the board. And some states, such as Illinois specifically, do remove that requirement for flow-throughs regarding withholding and composite for non-residents.
Go into some potential detriments of electing the PTE tax. The obvious one would be that you'd end up paying more tax. That's definitely going to vary case by case. Operating agreement revisions may be necessary. That's kind of due to the nature of the requirements by certain members or entities that are part of the pass-through entity. NOL adjustments, those may increase taxes since certain NOL adjustments are going to be needed to be made due to the pass-through entity making the election, and that's going to vary state by state. The pass-through entity tax may end up being greater than if the election was not made, such as in our California model that we have coming up. Can be binding in some states for future years. For some states, such as Michigan, if you're going to make the election this year, you're going to have to make it next year. And a lot of those states kind of change in whether it can be revocable or irrevocable. That's also a state-by-state case. And then it's going to impact the credit for taxes paid to other states. Some pass-through entities are either allowing a credit or not allowing a credit, or the credit is up to a certain limitation for taxes paid to other states by the pass-through entity. So that's also going to be another nuance in our consideration for whether we should even make this pass-through entity election.
You know, an example of that is there's a Maine case where, in that case, they did make, and they made what they thought was a mandatory election in Connecticut, and basically in Maine, what happened was they said, well, you know, we know they paid this tax and they have a credit for Connecticut tax, but this is not individual tax. Was it just the kind of high level summary of it? So we're not going to let you apply this to your individual tax return in Maine. And so that's an issue that will need to be dealt with, and just keep a heads up on states that are raising that issue. And then there's always the Supreme Court case Wynn that does provide, the recent one, that does provide that states must recognize tax credits from other states as a matter of the U.S. constitutionality of statutes. So in Maryland, that they were not recognizing tax credits from other states, and the Supreme Court found that they must recognize them. But then the issue becomes, can the state say that was a different type of tax payment, so you can't use it on your individual return? And that's what went on in Maine. So we need to keep an eye out for what states are doing there, and keep that in mind in terms of they may make it more difficult to take the credit.
One last note on that point. You may naturally question as a follow-up to that, well, is Illinois one of those states that is, you know, potentially going to give us some trouble here? Within the statute, Illinois did borrow language from New York's pass-through entity tax election to essentially state that the members or shareholders would still be able to qualify for a credit for taxes paid to other states where where the partnership or S corp pays the tax, so long as it's substantially similar to Illinois'. And within the past 2 weeks, I think they actually did it right before the new year, but Illinois' Department of Revenue has a web page for the pass-through entity tax that we can send a link out to as a follow-up for this if anyone needs it. But they did recently revise it to post to their list of substantially similar taxes. And it does include every state that has made a pass-through entity tax election. So the department is at this point indicating that it's not an area that they intend to fight.
That's a good point. And also, For that, in the case of Maine, I mean, that may well be unconstitutional because of the fact that not only is it a similar tax and there's Supreme Court authority on having states recognize these payments credits from other states. So I think we need to look at, that Maine case may go by the wayside, but right now it's still out there. And also the mandatory PTE tax. I mean, it seems just patently unfair if a taxpayer has to pay the tax in Connecticut and then they can't take a credit in their home state of Maine. That seems to be a problem given the alleged mandatory nature for Connecticut. So I think those issues will all be looked at in the future and perhaps resolved in favor of taking credits from other states.
Does the takeaway kind of make sense there to put a nutshell around it? It's if it's an Illinois partnership that files in 7 other states that it operates in, and 4 of them have a passive entity tax election, just looking at this credit issue, not other factors to consider, just on this credit point, you wouldn't have any issues there with your Illinois residents being able to take their credit for taxes paid to those other states. It's when you have a client that goes in the other direction that you just need to look at this a little deeper. So if you've got a Michigan partnership that files in 7 other states and wants to do multiple pass-through entity elections, that's about enough on that.
Got it. Thanks, Chris. Next, we will go into our models, and I think Ellen will go through these with you.
So we put together, just a few models to hypothetically look at the effects of these taxes in several states. And Chris can chime in if he's still on the call with these as well.
Yeah, I'm not going to leave the call, so I can supplement as needed.
Sure. Okay. And then, so basically, we're just showing a very simple example where we have distributive income of 5 million for California. We have the QBI deduction, which we're earmarking at 1 million, and then federal taxable income. And following that, we're applying apportionment and showing the individual California taxable income for each partner, one of which is a resident and one a non-resident. Can you go ahead and move to, thank you. And so in this case, we looked at what if we don't make the PTE election. And so we look at the California taxable income, and for the non-residents situation, they're going to have to pay withholding or composite if the state allows composite. So in this case, they're doing withholding, and their California tax marginally is reduced by that withholding. Then when we look at that tax paid by the shareholder, one who's a resident and one who isn't, you can see that they take the withholding and pay additional tax on other income due, and the end result is the 1,072,000 and the 906,000 for the non-resident. There is a difference then if a PTE election is made, and in this case, the total tax due ends up being more for the resident and non-resident. This is a possible result in California. And so the issue is after the marginal federal tax is applied, then we have to add back that tax at the state level, and we add that back, and then a portion, we have the non-resident withholding that was already paid in, and then calculate the PTE tax, which is at 9.3. It's under the marginal rate for California, which I think is up to, isn't it up to 13% in some cases? There's an additional 1% for, I believe, for income over 1 million. And you can correct me on that, Chris.
That's right.
I didn't look this up just today, so
13.3% over 1 million.
13.3. Okay, so with the million, it's up to 13.3. If you're not over the threshold, then it's 12.3 is the top marginal rate. So we have marginal California tax, and then we have the issue with tentative minimum tax, which the credit does not apply to. The PTE tax credit does not apply to. So basically, our PTE credit is allowed against taxable income to the extent it is not tentative minimum tax. And that's what the line PTE tax credit allows reflects. So in this case, the tax paid at the entity level is $232,500, but it's not, obviously they're not getting the full credit at the individual level due to the tentative minimum tax limitation at 7%. And so the end result here is that the total tax due is actually higher because the PTE tax is imposed at the 9.3%. It's worth noting if this were a composite case, the composite tax might well be higher than the PTE tax rate, and there would not be such an increase in total tax due. But in this case, because the PTE tax rate is higher than tentative minimum tax rate, it does result in a negative application. And Chris, if you want to add to this, you put together this model, so I want to make sure you add any comments you have.
Sure. I'd just say the highlights are, we pointed out earlier in this presentation that generally making this election is going to relieve your withholding requirement. California is an exception there where they've come out adamantly that, and it's true that nothing in the law did anything to affect the withholding requirement whatsoever. It's not as negative as it sounds because essentially you do have to pay that first 7% of your tax either out of pocket or through withholding anyway because of the mechanics of this credit. So you can see in this example, either he can get that withholding credited against his 166,000 tax to the extent of 87,000, or he doesn't have that and he's going to have to pay that out of pocket, but he's not going to be able to get the entire 116 of PTE tax to apply to his personal tax due on his personal return. So it's not necessarily a bad thing that the withholding requirement's in place, but it's one more payment and one more filing. The other thing, and this was stated there, but just to really highlight it, if you look at your no PTE election side and PTE election made and hone in on the California taxable income, it's going to be the same in either example. So nothing you're doing with this election changes your California taxable income. You're going to have reduced federal taxable income, reduced federal taxes, but you're going to be paying 16.3% marginal California rate in this first year due to how the credit works there. And that's why we've included the 2-year effect here, which which may be a little misleading because year one, the detriment shown there is the net additional tax that you would pay in year one. Year two is not a deduction benefit, it's a payment benefit. So what happens in year two is you would reduce your personal estimated payments or opt out of withholding to the extent of 75,000 or 37.5. So the long story really is, or short of the long story is, California's got some significant nuance compared to other states that requires it to be a little more of a proactive planning approach, and it may make sense to make the election in 1 year and not the following year, and you have to kind of just take it year by year. But California does give partners and shareholders the ability to opt out of an election, unlike the majority of the states that bind everyone to it as long as they qualify. So there's ability to preserve your tax position here, but we've got to identify what's the right answer and do it.
Yeah, one more thing that comes to mind on that too is if there's basically an operating agreement in place that doesn't allow, for some reason, this election has to be made in a certain way, or doesn't allow opt-out, that's another issue that comes up. Is the actual operating agreement supportive or negative, or could there be unintended consequences because of that? And then the other thing to remember is that it can't be refunded. The credit can't be refunded, which obviously is being shown in the model. It can't be refunded. It has to be carried forward.
I was going to say California specifically here does have certain entity types or partner types that are not allowed to be included. So you look at that from an S corporation perspective, and there's unsettled questions here, really from a federal perspective, that AICPA has sought request for clarity on, and of course nothing has happened there. But mechanically, certain S corps may not be able to make elections just because of the disproportionate allocation issues or double dipping into AAA that it causes. So just yet another layer to consider. And the double dipping to AAA comes from the fact that the IRS says for an S corp, the credit that you receive reduces AAA, as well as, of course, the deduction that affects your ordinary income would reduce your AAA as well.
Those are good points, especially with the requirement for the proportionate distributions. Wisconsin, if you're on the call, Chris, would you like to present?
Wisconsin, we included Wisconsin since it's obviously a very common filing for the firm, and it does take a different approach with that, what we're terming the exclusion method, meaning Joel, the non-resident partner in this example, if he doesn't have any other Wisconsin source income but for this partnership, he would not have to file a Wisconsin return. If he did have other income, he'd report the other income and not this income. Essentially, mechanically similar to a composite tax in that regard. The extra layer that introduces to consider, and it's very minimally presented here just for a simple example, but when you have a PTE tax that takes that approach, it adds the extra consideration for separately stated deductions and income, because you don't, if we go back to California, you would file your own California individual return after the entity makes the election, and any of your separately stated income and deductions would still be accounted for at that point. With Wisconsin, you're not reporting your pass-through income, so you don't get to report other other associated separately stated items such as your half self-employment tax deduction or self-employed health insurance or unreimbursed partnership expenses, NOL that you've generated at the individual level, any items that you'd be accounting for individually. So here we've got the personal exemptions removed. It's only $1,400, so obviously not much impact. But just showing that in the default scenario, you would file a Wisconsin return and you would receive those deductions. But if you're making this election, those deductions aren't going to be factored in. So I think you can go to the next slide, Neil. Thanks. And so the difference between California and Wisconsin here, it's all the same facts. So I don't want to run through the high level facts again, but your key difference here is because it's the exclusion method versus that credit method, you are going to have changes in both your federal taxable income and your state taxable income. We're only accounting for a $1,400 personal exemption here, so not a very visible difference, but a difference nonetheless. And really in terms of the Wisconsin model, I think that's kind of about all we need to go through. The non-resident withholding requirement does get removed from Wisconsin when you make the election. You can see on the right, so that's more within the bounds of most states, unlike California. The real point about Wisconsin that I wanted to bring up, because we do have a lot of Wisconsin returns, that this will be something to consider, and calling back to our repeated reminders about the credit for taxes paid to other states. Wisconsin does have it written into their enacted law that, as it says down in this bottom left corner, that you can take a credit for taxes paid at the entity level for other entity level taxes. But say you have a multi-state partnership that files in 30 states and only, 22 of them have passed through entity elections and the other 8 don't. You have an issue where those 8 states that don't have a way to pay tax at the entity level, you now have no way to claim your credit for taxes paid to those states at the individual level because you aren't able to file an individual Wisconsin return.
It's worth noting, arguably, too, that may well be unconstitutional in its application. And so we need to keep an eye on, any challenges to the statute in the future, especially under recent Supreme Court cases. So it's not unusual for a state to enact something that may be unconstitutional and can be overturned.
Or even in these 22 legislative sessions here, like last year, Alabama, after they initially did it 2 years ago, they came back and made some changes and improvements, and there's a lot of backlash on this credit issue, and it has created a lot of fear and uncertainty around the election. So we don't want to be in the business of prognosticating here, but it's possible that some of these states that are like Wisconsin and initially taking that position may either back off of it administratively, or in Wisconsin's case, it is their state law, so they may well just pass new law that kind of opens up that issue or clarifies what happens in that nuanced scenario where there's certain states that there's no practical way to produce the credit. Simply say it can be claimed at the entity level, for example.
Yeah, it's definitely worth noting there's a Supreme Court case, WYNNE, WYNNE, that does state that this is unconstitutional in its application and they'd have to repeal it. So it's a pretty flagrant. To just prohibit credits across the board like that is a pretty flagrant violation of the Supreme Court ruling in that case. So we may well see more from Wisconsin on that.
And our last example here with Maryland is that third scenario where it's high level like California, in that individuals still have to file their own personal tax return and claim a credit for their share of tax paid by the entity. The difference is Maryland doesn't have issues with the tentative minimum tax and limitations on how that credit will be received at the individual level, as well as the fact that it's refundable treatment. Beyond that, this example here is substantially similar, so I don't know if we need to walk through it. Our Maryland taxable income should be the same in either example, so you're still filing an individual return. QBI deduction you generally don't get with states, regardless of whether you're making the election or not. So I guess just want to point that out and make that clear that you see it visibly being backed out, or reducing the federal taxable income on the right side and coming back into the Maryland taxable income. But that's kind of independent of this decision. That's just, states generally don't allow the QBI deduction regardless. I guess the last thing I'd point out there, you don't have to go back, Neil, but you'd see in all three of these examples, generally the resident partner shareholder is naturally going to realize a bigger benefit from this than the non-resident, just because they have more income allocated to the state.
I just wanted to mention too, in Illinois, we need to keep in mind that when calculating the PTE tax, that the NOL is, which is allowed for replacement tax, is not allowed for the net income calculation for PTE tax. So this could deter potential companies with cash flow issues.
Yeah, really good point. And that is unrelated to, if you have in the back of your mind the legislation that capped the NOL deduction to 100,000. It is separate legislation. So Ellen's saying here that you don't get an NOL at all, not that it's capped at 100,000.
Okay, so we also have some form examples that Ellen was actually helping prepare for one of our clients. Here we have Form 511 from Maryland. It's pretty simple in terms of the actual application, but I think the key things to remember are making the right inputs and access, as well as kind of reporting the individual members pass-through entity tax payments that were made. So like as you see on this next example, it will actually lay out on the form all the taxpayers and their distributive income and the tax paid on their behalf by the entity. And then each one of the members receives this essentially information K1 that goes through kind of your typical K1s and make sure the pass-through entity election tax paid on the members' share of income was provided by this form. Anything to add to that, Ellen?
I'm hoping to do a short presentation just for our preparers to help them through this, because it's one thing to know that this tax should show up on the K1, for instance, here on D2, but it's another thing to get it to show up. So it's just a matter of the inputs can be a bit difficult. And now that we may have non-resident tax paid and the PTE election both to reflect on the K1, which is another issue where we want to make sure we get it to reflect properly. So that's something else that I hope to present, or at least send out some example slides on, so that everyone has a better idea. I think we're at time now, so
Yeah,
I will send something out on that.
got it. Well, thank you, everyone. I would direct questions to the SALT email. Hopefully, we can reach out to you and provide some answers on any urgent questions or any questions at all regarding the pass-through entity tax. Thanks, everyone.
Thank you, Neil. Good job.
Thanks, Neil.
Good job, Neil.
Take care.